Check, 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 check. Yeah, there we go. So I'm gonna turn this off.
Welcome. Thanks for coming. There we go. There's my mic. Make sure my sweater's situated. Thanks for coming out tonight to our first Caldwell event in Los Angeles. This is a big, exciting time for us. This is the first time that we've done an event on the West Coast, and the first time that we've done an event not in collaboration with MIT. So kind of two things happening for us at this time. The very first thing that I want to do is thank the community here. The one thing that we want to accomplish with all of our events is to give information and insights to the community that's given so much to us. We started as a one-man shop less than a decade ago on MIT's campus. We've grown to roughly 60 of us. We have offices in Boston, Los Angeles here, and more recently in London. We've been in the Los Angeles area for a couple years now, and we're just getting ready to make our third office expansion, which will be complete in March of next year. This is only due to the profound support that we've gotten from the community in Los Angeles. When we were first moving and creating an office in LA, people were saying, well, why would you go do this? And there was some people had maybe not the nicest things to say about Los Angeles, but we have found it to be a wonderful place with friendly people, innovators, forward thinkers, and people that are doing what they can to advance technologies and in companies and create jobs for members of the community. So thank you for such a warm welcome. We appreciate it. I also want to thank Mona, who is in the back here. Mona, thanks so much. If you guys don't know Mona, Mona's our director of marketing. Like many people that have joined our renegade law firm, she took a leap of faith, leaving a very stable tech job of many years to come join the maybe less exciting law firm community, and has innovated, has led a team of folks to be able to continue to push out our messaging of what can be possible with using intellectual property in the tech community and even broader with some of the corporate work that we do. So Mona, thanks so much for all the hard work in putting this together. We appreciate you. Thank you. I'm very excited about the folks that we've put together for the panel. I guess I want to thank everyone that's come out today. Thank you guys so much for coming out in person and battling the Friday afternoon Los Angeles traffic. That is a feat in and of itself. We had actually attempted to make this be on a Tuesday or a Thursday so that we wouldn't have to deal with the Friday traffic, and it's always harder to convince people to come listen to lawyers and financiers talk about anything on a Friday than it is on a Tuesday or Thursday. That's why we've tried to coax you with booze. Anyways, thanks for you guys for coming out. And I think that we have, I don't even know how many people are on the live stream, but 50 or 60 folks on the live stream as well. So thanks to all the folks in the live stream. Live stream folks, hi, thank you for coming. We appreciate you. And without further ado, I'd like to just briefly introduce myself. I'm Keegan Caldwell. I'm the founder of Caldwell. Like I said, we started as a small shop. We've grown significantly. And our focus, to not be redundant, has been on intellectual property thus far. We have a growing corporate practice, and we do plenty of litigation in both of those practice areas as well. One thing that we've been laser focused on from the beginning is making sure that we deliver a return on investment for any spend on intellectual property, and we've been quite successful at doing so far. We've done billions of dollars of transactions since we've started, and we work with over 200 venture-funded companies. And we've done work with everyone here on the panel. We're very proud to let you hear what they have to say today and give you some insights into what we're doing with a unique asset class that has been underutilized for a long time, but now we have a lot of data to support the growth and the forward movement of companies by using this asset class, and these guys have the experience to talk about it. So that's me. Go ahead and pass it over to Oliver, give a brief introduction.
Yep, much appreciated, Keegan, and pleasure to be here today. My name is Oliver Swig, and I am a co-founder and managing director at Soja Ventures. Soja Ventures is a family office and alternative financing firm with a focus on early, late stage, and venture growth companies in the greater tech sector. We invest and co-invest with other family offices and strategic institutions, some of which are on stage today. And Soja Ventures was really designed to be an extension of our larger Swig family office, which is the family office on my father's side. We are predominantly a real estate focused family. We own and manage about 10 million square feet of commercial office space cross country, centered mostly in the California and New York markets. Funny enough, it's an honor and privilege to be here today speaking at the Fairmont as our business launched several generations ago by originally starting and founding the Fairmont hotel chain. So if you have any troubles with parking or room service, happy to take your critiques, but I'll defer you to the concierge for the time being. So it's a pleasure to be here.
Thanks, Oliver. Mark, you want to give us a brief introduction?
I'm Mark Fox. I'm a co-founder of Ghost Tree Partners. We are a private credit firm, so we provide private credit solutions to the lower middle market across real estate, asset-backed financing, specialty finance, and then corporate cash flow lending. And one of the areas that we've been focused on recently and have executed a number of deals in is IP-backed loans. So it's a big concentration for us, a growing area for sure. And so we've had the opportunity to work with a number of people up here on the panel.
Thanks, Mark. Alex.
Yes, hi, thanks Keegan. Oliver, I'll ask you to validate my parking ticket later. Alex LePage, founder of Miller Hill IP. So we are a strategic advisory firm in the IP space, mostly focused on valuations. And this is a timely and relevant topic. We do so with early and growth stage companies in order for them to hopefully obtain IP-backed debt, and also work alongside them. I have a long history in technology. Work alongside them to basically bring product and IP together. Oftentimes there's sort of disparate strategies, and so we work to basically commercialize and bring those two pieces together.
Thanks, Alex. Jeffrey.
Thanks, Keegan, and really great to be here. Thanks for inviting me. My name's Jeffrey Doyle. I'm an investor turned entrepreneur. I started off my career in business in venture capital out of London, mostly investing in startup, early stage businesses, software, biotech, med device. Moved to the US about a decade ago to Silicon Valley, and there was too many VCs there. So I decided to actually start setting up businesses and helping founders. And I chose a technology which I found interesting called additive manufacturing. You guys might know it as 3D printing. That's my fan base back there, I apologize. Yeah. And I got involved in it, and I started helping entrepreneurs set up their businesses, and I helped found a couple of businesses, mostly focused on healthcare, because we all need healthcare, and it's a personal area of interest when you have family members that go through challenges with rheumatoid arthritis in my case, and it's a family issue, so I got very much involved in applications around orthopedic implants using 3D printing and nanotechnologies. At the other end of the scale, I've worked and helped set up businesses in the tech aspect of 3D printing material. I like to touch deep tech or application tech. In the middle with machines, it takes a lot of money and a lot of time, so I've really stayed away from how you make machines from an investment standpoint. I tend to go in pre-company formation, so I get an element of founder status, but also when companies get to a stage that they need my skills, which is mostly around kind of strategy, finance, fundraising, so on and so forth, then I go operational and try and help them out from a permanent standpoint. And so I work with Keegan on this panel, as well as Simon Oliver, his brother Simon, the Swigs Soja Ventures, to help us raise money. And I'll start off with a commentary about raising money, and why I'm interested about this particular area is, as an investor and an entrepreneur, we look to either our customers or our investors to support us while we commercialize something. Yeah, and that's where we've got to go. And if it's not there, you've got to look at other sources of funding, and this is one that we're particularly looking at very closely, is how you can use IP to fund our development of technology while we go and commercialize it.
Great, thanks, Jeffrey. I'll transition kind of quickly to speaking about your particular experience with starting with early stage companies. Usually, early stage companies are not going to start with doing debt financing out of the gate and start with doing some form of like equity raise, whether that's like some sort of traditional venture equity round. So can you speak to how your previous experience with doing venture equity and how that has played a role in arriving at this kind of unique opportunity here?
Yeah, it's a starting point because, you know, when founders come up with an idea, what do? You put your own time and effort into it to begin with, and then you go and find the 3 Fs: family, friends, and fools. Yeah, and they're the folks who get things going to a stage that you can build the hypothesis to go in front of, you know, more serious capital, the professional investors. And the great thing about the US is there's a lot of professional investors who are individuals. You know, the amount of money that is in the angel networks is now typically that, you know, up to 5 million to 10 actually. The VCs have got bigger and bigger and bigger. They don't want to touch things until there's a lot of commercial proof. And that's the starting point. And you hope you can find a good investor who has the depth of pockets as well as the connections, because it's all about relationship, trust, and what's the word I'm looking for? That, you know, people, you know, reputation is everything. Yeah, and you want to be able to work with people that they can trust you and your ideas, knowing that they don't always go right. But the starting point is yourself as founders, and then you go and reach out to your connections to get you on your way. That's my experience.
Sure, and then I guess I'd just be curious too, and feel free to jump on this as well, Oliver. Can you speak to like the role, since we're talking about intellectual property and being able to use in particular patents to collateralize those for debt, has that played a role in any of the equity raises that you've done in the past with other companies?
You know, investors always like to see that you've got an idea that's going to be penned in a patent. I think generally everyone likes to see that you're thinking about it because no one wants somebody else to go and steal that idea. I don't think that's always at every entrepreneur's forefront of their mind, quite honestly, because they're trying to prove something and they're trying to articulate something. I think the more technical CEOs, that's the first thing they go to. So in one case, one of my CEOs, he was a PhD, so he was very used to doing patents. The other CEO was more commercially focused, so it kind of came second. But from my perspective, I don't look at patent portfolios when I get involved in companies. I look at the people, the market, how big it is, what's the differentiator, and then I get involved. So maybe I should do it the other way around, actually. You know, I'm learning something now around IP because it's never been the first thing on my mind when I think about getting involved in a company.
Yeah, Oliver, when you guys are looking at potential equity investments for your portfolio companies or prospective portfolio companies, what are you guys only looking at IP-rich companies, or do you guys look at pretty much anything that comes across the table? What are the key factors there?
Yeah, I'd say it's more of the latter. We try not to pigeonhole ourselves off of our criteria, but in general, IP plays a really significant role. I would say, you know, similar to my experience in the real estate background, we actually look at hard assets in a similar fashion as we do intangible assets. Okay. You know, looking at a new economy for intangible assets versus an old economy, for lack of a better phrase, with hard assets, it's an important process for us to determine the monetization of IP. So if you have a $100 million building, for example, we look at across the street at your offices, I'm sure there's a similar valuation attached.
Sure.
You know, what gives you confidence in that valuation? You would look at, you know, third-party appraisal, confidence within that appraisal system as well. You would look at market comps, the marketability of the asset as well, and the confidence within the market of buyers who are looking at that asset from a perspective of potentially purchasing it. We look at intangible assets in a similar fashion, and we use the same precision in hard asset lending as we do in terms of the monetization of IP. So, you know, speaking with the other professionals we have on the panel here, is there a definitive path and execution to a monetization of IP? It's something that Collateral IP would be very familiar with. And from a third-party appraisal and valuation system from Miller Hill, what does that look like? And can you lend against that as well from a perspective of Ghost Tree Partners? If those criteria, lend confidence in terms of boosting the monetization of an IP portfolio, we would feel confident lending against that and taking a closer look and providing actual value to the IP portfolio within the other key metrics we look at, which is, of course, the quality of management, the financial metrics, revenue, and pathway to EBITDA positivity for companies we look at in that venture growth stage. So it plays a very important role, but in a similar fashion to how we look at more traditional assets, we try to apply that rigor to more of an intangible asset and new economy perspective.
Yeah, there's a lot of things there that I want to circle back to that are very important. I think that there'll be a lot of audience questions about as we dig into some of that.
Not
Mark,
to jump the gun over here.
no, it's great. No, I don't think you jumped the gun at all. I'm glad you jumped right in. Mark or Alex, do you guys want to add anything about equity and IP? And Mark, does that play any role when you guys are looking at doing debt deals? Do you need to have been equity raises before? And then if there has been, are there any hiccups related to things like that? How do you guys view that?
Yeah, so in terms of, how do we evaluate equity and equity partners, we really try not to. So we want to know how much capital is going into the business. We want to know who put the capital in. And then that's pretty much it. We assume that equity's not going to be there. If we have a situation where things look like we may be taking over IP or we may be in a restructuring situation. And so our focus is very much on the assets themselves, which we'll talk about, and the management team and the strategy, and much less so on kind of the equity thought process going in, and frankly the names on the shareholder list.
Tell us a little bit more about that. What is the you're looking for names that you think will draw in other potential investors, names that might be red flags for making an investment or wanting to tie yourself to those folks, all the above? Is that?
No, I would say it's the other way. We don't take comfort in, well-regarded equity names on the shareholder list, assuming that they're going to bail out the company if things go badly.
You want less reputable people?
No.
I'm just kidding.
We just know.
We can get that for you, and we can make that happen.
We've seen throughout our careers, equity, very smart investors, very sophisticated, but they think about the world differently than we do. And their incentives are very different than ours. And their return outcomes are very different than ours.
Yeah.
And so ultimately, our expectation is if we're talking about sort of a bad path with the company, there's going to be no help whatsoever from equity, no matter who it is or how much has gone in.
Okay. Alex, do you want to add anything?
Yeah, I was just going to mention, I think it sometimes it goes without saying, but in most venture capital, especially in the last 20 years, 15 years, mostly relevant, they are, IP is probably number 20 on the list of criteria, if at all. And for good reason, right? Because they're looking for, again, the people, the idea, and mostly if you can get traction, because they want revenue to happen, right? They are looking for the network of names that can help build this thing. Maybe you're just building an idea, right, and into an IPO. So anyways, I'm sure we're going to get into this, but I think that is certainly begun to change, especially since we've moved from sort of a more static manufacturing-based kind of economy to especially now with clean tech and med tech and all kinds of things, and the focus the last 15 years really has been on SaaS software only, where again that the philosophy in equity is they've got to run as fast as they can, and we're going to outrun defending any unique idea or any patent.
Yep.
And I think that's changing given the nature of the economy, but also, as many of you've already discussed, sort of looking for alternatives to that type of funding.
Yeah. That's a great place to transition and start to introduce doing some of this debt. So my personal experience in intellectual property, and when I was just getting started, I noticed that there was a disconnect in between, in general in my industry, and between the folks that were acquiring the patents, kind of organically for companies, and the folks that were monetizing those for companies. And we wanted those two heads to kind of speak with each other and to create as many options for monetization down the road, right? Whatever that may be, whether that's using it to be able to utilize an underutilized asset class is essentially what I sought to do. And when I first got started, I tell the story a lot. I was reading this book called Patent Valuation, published by Wiley Publishing Company. It's kind of been like the preeminent text for patent valuation for 20 plus years. And I remember making it through the first couple chapters of that book, and I thought, these guys are making everything in this book up, right? And I think that it was just applying there were so many different mathematical models that you could apply to numerous scenarios that you could kind of manipulate things how you wanted. And, we see these sorts of things all the time doing deals, right? To, push this a little bit this way or push this a little bit this way. But I think that the way that things have ended up is that we've went from somewhere where we didn't have lots of data points, because it was something that was generally kept behind closed doors doing these large IP transactions. We didn't have well-established royalty rates for anything outside of device components, which we have had for 20 plus years. And if there was IP-backed debt funding, it was in the realm of device components, whether that was cell phones, televisions, computers, whatever. And now we've got enough publicly available sales data, publicly available royalty rates and settlement data that we can have. We don't need to take it on faith as much about what the value of the IP is. We can basically, if we can find the right valuation team, we can determine with some degree of accuracy what is the value of the patents within a particular area of industry. And we can even do that like in additive manufacturing, like the sort of things that you're doing, Jeffrey, to HR tech, to car washes, right? Almost no industry is safe from valuing patents at this point. And it greatly benefits everyone, because now it's went from something where it had to be speculative before to now it's something that we can show to investors with some level of integrity to dissolve the liability of that investment by using an asset class that traditionally we haven't been able to use that much. So this is the one thing that I've noticed that has changed dramatically and has changed a lot of the things that we're doing at our firm. So I'll use that as just a segue into my next question, which is, do you guys feel that IP-backed debt lending is still in its early days? And feel free to add maybe what your experience has been so far, or your own perspective on how we've arrived at where we've arrived at today. I'll pick on someone if you guys want me to. Go ahead, Mark.
So it's IP lending is absolutely in its early days, and if you think about how it kind of fits in, I think it's exactly right. Keegan and Oliver touched on this earlier. So I've spent my entire career really doing two things: trying to value a lot of different kinds of assets, and then come up with the right structure to make sure that we've got the protections we need and the recourse to those assets that we need. And part of the challenge is, well, an asset is valued at X today, but what about if we go into a recession or we go into an inflationary period? So that's been my task for my entire career. And for the 20 plus years I've been doing that, IP has never been something that we have focused on. It's never been something that, whether you're in the levered loan market or you're in the high yield market or you're in the middle market direct lending business, that has been focused on. Now, there's some exceptions to that. There's a few lenders out there that have created some really interesting businesses and have been ahead of the curve. But that's traditionally been the case. I think there's been a lot of really smart people that have wanted to create some new technology. And I'm going to butcher this stat, but it's something like more than 80% of the assets on the balance sheets of the S&P 500 are not tangible assets.
Yeah.
Right. And so there's no reason why we shouldn't be finding a way to lend against those assets. Now, we're going to talk about the way we've been doing that to date, and we need some infrastructure around it, because I think traditional lenders like ourselves haven't had the exposure to the data points and the data and really dug into it to get to the point where I can tell you pretty accurately what a receivable is going to recover in a liquidation scenario. I think we're still building up to that knowledge base of what does it look like for certain IP portfolios, and what is that going to look like from a liquidation scenario or a fire sale scenario.
Sure.
And we're working through that pretty steep learning curve now, trying to execute deals, trying to execute good deals with the idea that in the not too distant future, IP is going to be similar to real estate or FF&E or working capital or loans from an origination platform, as they sort of sit today and have been lent against for decades.
Yeah.
And
Yeah.
I think
Go ahead.
to build on that as well, just looking at the financial metrics that define IP lending, and Mark could speak to this more confidently than I, but going back to a real estate analogy as well, that you'd be confident to an LTV or loan to value ratio, you get about 80% on a real estate asset. Just in the past, the equity markets were incredibly robust for the past 5 years, and the past 12 to 18 months has seen a large dip that has, I think, encouraged more private lending, alternative debt solutions as well. You look at the loan value for an IP portfolio, companies now are lending up to about 50% of a loan to value for an IP portfolio. Just 2 years ago, I think that was closer to about 30% on the higher side. So we've seen a stark increase from that perspective, and I think that gives merit to the fact that this is a budding industry and a budding vertical that will constantly increase as the appraisal system matures and there's more confidence in the marketplace about what standards there are. I see that loan to value increasing dramatically, which would lend more credence to the fact that this is a trend and not just a deviation from the current market conditions.
Yeah, I think that's how I feel too. Do either of you guys want to add anything to how you feel at all about whether this is the early days of?
Yeah, I know I would. I've got direct experience with royalty-based debt. Yes, it's in its infancy. There are some unknowns, I think. You got to go through the cycles and see it. I did my MBA 20 odd years ago when we were valuing telecom providers as total revenue per lifetime of a user, if anyone was in the investment banking community back then, and you got insane valuations because of it, because you're using metrics or valuations that you're looking forward, you don't know. I think with better analysis and data, it's going to be less risque, but there's a general trend of overvaluing things generally at the wrong time. We see it time and time again. My experience with direct experience with royalty-based lending, which I would say is like an IP lending aspect, is it's gotten confusing with the equity side of the balance sheet because they don't understand it. Mm-hmm. Yeah, because anyone who comes in with a IP lending hat is taking risk. Yeah, and though it's packaged up as debt, it's more like a hybrid debt. Asset-based lending is hybrid. There's risk associated to it. And my experience is the equity side has not understood it. Yeah, and it's actually I can't go into too much detail. It has created challenges around trying to pull off in transactions because people are trying to fight because there's not clarity over what's the value of the secured cash, because it's cash debt against assets which are not fully commercialized. So I think the point of it is there's a time when it's ready to be used, when you're closer to commercialization, as opposed to too early when you're 5 years away from commercialization. That's my experience. It's got a place to play. And I think one of the reasons it's got a place to play is what's happened recently with the demise of Silicon Valley Bank and all that ecosystem, which, any VCs in the room? Yeah, created by the VCs. The VCs took their money out, told their portfolio companies to take their money out, and what did they do? They killed the lifeline to the entrepreneur. Because the first people that the entrepreneur would go to is SVB, Bridge Bank, First Republic, and say, well, give my shares, I'll get some cash so I can have some balance with the venture capitalists. Now that's gone, we're looking, and I'm actively looking for other ways that I can use the assets in our business to counteract the venture capitalists, because they are very opportunistic. They've got a lot of portfolio problems, and quite rightly, they're looking after themselves, and the entrepreneurs are trying to look after themselves. And the great thing about entrepreneurs are we're very entrepreneurial. We'll go find other sources of capital if we can. And this is what attracts me to this concept of IP lending. It's in its infancy. Personally, I'd welcome it being more mature, because it's another source of capital that I can balance off my other investors. And it is my personal experience today, because things are tough out there, and our traditional routes have been shut off with the demise of Silicon Valley Bank, which was created by the community themselves to pull the money out of the bank to cause its collapse. Anyway, that's my opinion. Maybe not politically correct within venture capital circles, but I used to be in those circles, and now I'm an entrepreneur, and this is my personal view.
We'll just accept it as fact because of your British accent.
Yes.
That's right.
I should have put my glasses on, then I'd look intelligent as well. Yeah?
It's important always to add a British person to any panel.
On that note, what I really love about America, and I am from over the pond, is in venture capital terms, the US is so more advanced in taking risk and making things happen. Though you critique the venture capital community, you try and raise any money in the UK or Europe to do what happens daily in America, it's tough, really, really tough. So actually, having a robust venture capital industry is important, but they do look after themselves, and I will end there with my preaching.
You brought up a salient point that I haven't given a lot of thought to, but I think it's what I'm witnessing today, and that's that there's a lot more motivation for the debt folks to figure out the asset value of intellectual property, because the companies are motivated to get creative, to use whatever assets they have, right? And so the debt folks are really the ones taking the risk in figuring this out. I think that ultimately that we'll see the venture capital folks and the other folks on the equity side also work to try to utilize that value as much as possible, because as we establish and get more and more data points on that value and can solidify, like you're talking about, and be able to drive up what we could, the integrity of that value to whether we can loan against it or however we can add it to the balance sheet. That will be useful for the folks on the equity side too, because they were going to want to drive up the valuation as much as possible. And if they can do so in a way that is reputable and doesn't cause them to drive up valuations too much, but in a reputable way, whatever that is on the VC side, then I'd imagine there'd be some motivation to do that, right? Does that make sense to everybody? You guys, yeah?
Yeah.
Okay.
Yeah, I mean,
Nodding approval.
Yeah. Go ahead, Alan.
SVB was, and now through First Citizens, we believe, right, is still, I think, leading the charge in terms of evolving these asset classes and being innovative in the space. We could spend 3 hours arguing whether it was the right business model. I think it was. I think it was a solid business model, and for other reasons, they've hit a stumbling block. But just going back to the sort of, I love the how you guys have related it to hard capital assets, real estate. If you think about it, and again, I think it's 80%. I think it might be 90%, right, upwards. Is you think about a company. Now we're talking about, in the S&P, obviously these massive companies that have huge brands, but the brand and the customer asset, the customer data list, and then what's unique about their product, that is what is driving all of the value. And that's where every company, no matter what size they are, is working towards. And so it's a spectrum. And if we can, I think, facilitate the lending and the you know, essentially the startup help to facilitate you know, being able to value and look at what we call intangible assets, but in a lot of cases, a customer list is very tangible, and we can say exactly how much revenue a company derives from X customers. And again, looking at the IP and making sure that it's not just, it can't be just there's a bunch of patents sitting around on the right that somebody has developed, but a leading firm that's strategically positioned and oriented around how are we going to turn what you're doing in terms of product, how are we going to defend that, and potentially opportunistically, you know, go after other companies in that space. So it's not just we're going to put a giant value on a bunch of stuff that a law firm made up, but more so that we're looking at, you know, the combination of the market opportunity that this IP really offers the company.
Thanks, guys. That was a great discussion. I think that thinking about time that we have, I want to shift gears and talk a little bit about how insurance has begun to play a role in debt funding. I've done panels with a couple of you guys have done panels with you previously, and we've also done with some of the insurance providers that have begun to insure the value of an intellectual property portfolio, or their value in intellectual property portfolio, and insure an investment by a debtor. And one of those companies that has kind of gotten this started the last 3 years has been Aon. They're one of the largest insurance companies in the world, and they took one of the lead folks from Microsoft that was doing their IP there to bring them over, and teams of other folks, and they made a couple of strategic acquisitions to assemble a team of about 150 people to begin to value intellectual property portfolios and to lend against those with their own fund, or to be able to bring in outside funders and provide an insurance policy, an insurance wrap on that debt lending. So you guys are all familiar with this. Lots of the folks in the audience are not. Mark, maybe you can actually speak to just some of the nuts and bolts of this Aon program. I know that you've done a few of these deals. I've worked on some of these deals also. Maybe just give some of the basics on how many patents, you know, revenue, EBITDA, like what's too early. What has your experience with that program so far, and why is that something that you guys are interested in at all, that you'd want to have the insurance wrap versus doing the deals? I know that you've done them both ways, so maybe you can speak to all those things.
Okay. You have to remind me about 4 or 5 of those questions in that question.
Yes, I do that on
I'll come
purpose.
back to you.
Yeah.
So maybe just start with what is the Aon program? Aon, to their credit, saw this phenomenon with the S&P 500, and they're an insurance broker. And so when you see an asset that you don't insure getting more and more important, and the assets that you do insure or broker insurance on becoming less and less important, they recognized that, and they said, okay, how can we address this? And so they created a valuation team, and the idea is either Aon itself or outside lenders like us can bring a borrower to the Aon valuation team, and the Aon valuation team will go through 6 to 8 week process at best. Sometimes it's a little bit longer, but a 6 to 8 week process, and they value the IP of the company. And so think of that as a real estate appraisal. And I think we've probably all had experience with real estate appraisals. If you got a real estate appraisal in early 2008, what that looked like in 2010 wasn't great. So the really important part of the valuation piece is they're then taking that valuation and going to the insurance markets and saying, insurance markets, will you provide an insurance wrapper against, it's between 80 and 90% of the loan that lenders like ourselves and Keegan's point, Aon has their own internal lending fund. Insurers will provide an insurance policy against some portion of that principal, and that's based on the valuation coming from Aon. And as was mentioned a couple times up here, generally think of that as a 50% LTV. So what does that all mean? If you've got a company with a $100 million valuation of IP coming out of Aon, a lender like ourselves can provide a $50 million loan against that. And then the insurance brokers will be insuring somewhere between 40 and 45 million of that 50 million loan. So we have completed 4 of those deals to date. We're hopefully closing our 5th at the end of the month. We think Aon's done a really good job kind of being out in the forefront and bringing very conservative insurance companies that are recognizing the same thing as Aon into a market that they're unfamiliar with, and really doing a lot of the work, of the evangelical work that's required to get this off the ground. From our perspective, we think about the 3 players or the 4 players with the borrower. So it's the borrower, it's the lender, it's the Aon valuation team, and it's the insurers. And that ecosystem has worked well together. Again, it's not perfect, but has worked well together to create an economic solution or a capital solution that's not available in the market, has not historically been available in the market. And so this is a very non-dilutive solution that provides a lot of capital to borrowers that are at the inflection point of really being able to commercialize IP that they have been developing for 5 to 10 years. Mm-hmm. And so we'll get into the profile in a second, but maybe one of your questions is, what does the insurance do? I think it adds to the ecosystem, it adds some validation to the ecosystem. It honestly gives us as lenders a little bit of a set of training wheels as we get up the learning curve of how to think about IP and how to value IP and how to incorporate that into our liquidation scenarios and our downside scenarios. It gives us a little bit of help as it allows us to provide larger capital solutions to these companies. We really don't want to be in a position where we're bridging to another round. We want to bridge to cash flow, not even break even, but cash flow generation. And so having insurers in there has really helped us do that. You want me to talk about kind of the profile of the companies?
No, this is it's almost great this could be its own panel in and of itself just to talk about. We've had it be a panel before. So I'm just trying to hit kind of the quick points, and then we'll leave it open for questions from the audience to continue to discuss that a little bit. So just so everyone's clear on that, and I think you did a great job of breaking that down, though, that you've got the folks, the companies that are trying to raise some debt utilizing their asset class. You got the lenders. You have Aon that has its own valuation team, and then you have the insurers as well, which is a little bit confusing because you think that Aon is the insurer, but they're kind of they're a broker, and they're going out and getting this secured by all these different insurers and pooling kind of all of these insurers to get these larger deals done. So and this is provided, they've kind of done some real groundbreaking here, where they were the ones that, in my opinion, have taken the turn from only the traditional type IP device component companies to looking at an array of different companies and being able to leverage an IP asset across different industries. And I'm actually very grateful for them kind of taking the lead on that. Now, contemplating that, and I think that we can talk about this actually in the realm of Aon and just debt lending in general, because I think the two really kind of dovetail at this point, because as you mentioned, it's helpful to have a team of 150 people that are very skilled in IP to kind of lead the charge for not just valuation, but to continue to teach folks what it is that we're learning all the way. You even mentioned before that like a lot of the industry valuation metrics that are available and out there that we constantly monitor at our firm, but they're coming out like every week. There's something new at this point, and so it's something that's unraveling today, right? But anyways, the requirements for getting this sort of debt and utilizing patents to get debt tend to be very similar. So do you want to just touch on that a little bit?
Sure. So generally looking for portfolios, IP portfolios that have patent families of 20 or so patent families or more. That's kind of the minimum. The valuation process does take into account trade secrets and other types of intellectual property, but patents, there's a very quantitative aspect to valuing IP and a qualitative aspect, and the quantitative aspect lends itself better to patents than to other types of IP. So patents are an important place to start, and then you add in some of the other types of intellectual property. Deal sizes through the Aon program at least tend to be $20 to $25 million at the low end, and those have gone up over $100 million. Then the profile of these companies is these are businesses that have established strategies, have established products, have some history in terms of validating their go-to-market strategy, and what they're looking for is a significant amount of capital to really help them accelerate their growth. So this capital is not really for R&D. It's not for expansion of the IP portfolio. It's to monetize existing IP, existing products, and so that looks like the more revenue that you have, the more partnerships you have, customer partnerships you have, reseller partnerships you have, the better. We just closed a pre-revenue deal, so you can do pre-revenue deals, but you need the offsets to be a really, really strong big customer with a contract in place or close to signing a contract, or multiple different products to allow you, when you go into the market, to generate revenue. You need an offset if you're pre-revenue. The best place to be is to be generating revenue and to have some validation of your go-to-market strategy. And then outside of that, it's we look very hard at management teams, at the teams in place that are going to commercialize this technology, these products. That might be the most qualitative aspect, but maybe one of the most important pieces of what we do is spending time with the management team and kind of connecting the dots between this IP portfolio, the product, the strategy, and who's going to execute it.
Yes. Thanks for all that, Mark. Appreciate it. Are there areas of industry that you think that this lends itself to more? Are there certain areas of industry that this is that either the folks at Aon or in general, the debt folks are less attracted to than others?
We've seen a pretty wide variety of deals. I mean, just ourselves, we've done one consumer product, 2 medical devices, and then one basically GDPR compliance software deal to date. And so it's a pretty broad focus. I think the IP itself can be valued across a pretty broad range of IP content. It really comes down to putting the pieces together in terms of where are you on your revenue development, where are you on the development of the product itself. We've probably looked at 100 deals, and I don't know of one that really sticks out as like, this can't work.
Yeah. Okay. You bring up a great point too of valuations kind of being all over the place. So thanks for all the basics on the Aon program and the debt lending there. I do think that my experience is also that valuations tend to be all over the place as well. And I think that my personal perception is that there are folks that have been doing valuation for a long time that are maybe less familiar with the publicly available data on the asset value of patents and, you know, the Gaussian curve of min, median, max per the different industries, and the different ways that that Alex can speak to more about the different ways that folks apply valuations to debt and equity deals, and how different technology sectors just have different characters to their value based on what data is available as well, and the business model itself. Alex, do you want to talk to maybe just kind of the nuts and bolts of valuation really quick?
Yeah, I was going to ask if I needed to leave the room, but your comments about valuations being all over the place. This is one of the reasons that, my background was in strategy consulting to begin, and then in technology. And one of the reasons that I've sort of arrived at this space was because, there's a couple of things, but I think from my perspective, what we've seen is for hard assets, for working capital, things like that, you've got investment banks that do this all day, every day, and have become, are finely tuned at doing valuations. But typically, if you've ever seen one or gotten one, what you're going to get is, they call it the football field sort of range analysis, right? And there will be a comparable, there will be a market, there might be a cost, and then there will be a revenue-based or a forward-looking income-based. And so personally, and that's what our firm aspires towards, is providing, this is not an asset that we're going to be able to say, you've got 20 patent portfolios, and so this is $422.5 million, right?
Yep.
So we typically provide ranges. That said, we have to keep it within, it can't vary by 800% or more. So, and I think, Mark, you mentioned this, there's a qualitative aspect and a quantitative. It's art and science. We were speaking about this before the panel, that, everything is about storytelling, right? So we're building a company, and we've got to convince you guys, we've got to convince venture capital, we've got to convince employees, everybody, of where we're headed towards, right? And so what we wind up doing is utilizing the most data we can to tell a story that's credible, that provides ranges, and that quite frankly, you can consume and then come back and say, I don't understand that. How did you come up with this number, right? So this shouldn't be a black book. It should be something that starts a conversation, so that we get to all those finer points of what's the management's experience in commercializing this particular technology. Why are your patent portfolios different than others? And then just the nuts and bolts, I think I mentioned it, but typically we're looking at the net economic benefit that is going to be generated by the virtue of holding the patent, and that's either because we're going to utilize it, the company is going to utilize it themselves exclusively, and be of benefit that others cannot infringe or sue them. Typically, and then the other alternative is really looking at where we're going to be able to commercialize for ourselves, but also potentially look towards infringers in the space. So the summary is, there's many different ways that you can provide evaluation. We're building a picture, and I think the more robust picture that we build, with the more numbers and the more data behind it, that helps everybody in the ecosystem to be able to evaluate whether they want to play this game or not.
Okay. I think that we have to wind things down because I have several questions on the live stream, I'm sure. Okay. And then we'll also take questions from the audience also. But before we transition to doing that, I'd like to give you guys an opportunity to maybe sum things up a bit. I guess the final question that I would ask would be, maybe, is there a right time for companies to pursue this? We've talked a lot about some of the requirements, but we've also talked a little bit about it's never too early, and it doesn't seem to be, there's certainly going to be some scenarios where it's too late. What does the sweet spot seem to be? And then maybe, Jeffrey, you can just speak to a little bit more about how this is such a unique value add for companies that you've worked with.
Want me to start?
Go ahead, yeah.
I think the value add is access to capital. Quite honestly, as an entrepreneur, we all need capital to keep the lights on until the customers start paying. As I said, I think valuations are an interesting debate because bankers value companies all the time, and sometimes they get them wrong because share price goes up and down. So there's some external forces to play. Availability of capital plays into it for one example. But a concern that I have from the entrepreneurial aspect is insurance adds more costs, which I can understand why a lender would like to have costs or would like to have coverage. And as I said before, I think the interaction between how the lender with the IP security sits with the equity provider, that leads to when's the best time to go and get it. My view is you go and get this debt when you're less reliant on the equity participant. So you get it when you're commercializing. And that's my experience. My fear is it could be packaged up and securitized like we saw in the past when you have derivatives, which if you think about insurance is almost a derivative on the underlying asset, and then it gets confused with the true underlying risk. And I don't know if this happens in the industry, that it's bundled together, then passed on, and you lose the underlying risk of the IP. I don't know. I've not investigated that far, but maybe it's a conversation point when we have a drink afterwards. So good thing. I'd like more of it, and we need new and different sources of capital as an entrepreneur.
Great. You guys want to add anything?
I would
Go
say
ahead,
that in terms of when's the best time to approach an IP strategy, in general, I think always. And for sake of this panel and the dialogue we're having, I think it's a very important asset to get on the balance sheet. What I would say is it's never too early. If you're really looking at the valuation of early stage and startup companies, in general, the biggest value step-ups between pre-money and post-money rounds tend to happen when there's a robust IP strategy deployed and executed between some of the earlier stage investment rounds. So I would, for sake of what Jeff was just mentioning as well, I would say that deploying an IP strategy earlier would increase the assets on your balance sheet, which would give you more strategies for an early stage company to go out and either pursue debt strategies or also increase your valuation in the earlier stages. So although it's very important for later stage companies, especially companies that are pursuing a SaaS model or a service type component, I would say that increasing the amount of assets on your balance sheet, specifically from an IP focus, would be an important early stage trajectory for a lot of these young companies.
Okay, great. Mark, you want to add anything?
Yeah, just 3 quick points. One, totally agree with you, Jeff. I think what you're saying is know your lender really well. I agree with that. 2, part of our job is to educate the market. So if a company comes to us and they're too early, part of our job is to explain why they're too early and what the steps are to get into a position where we could provide this type of solution. We're happy to do that. That's a good use of our time. It's part of our job. It's part of how we're going to grow this market.
Yep.
We want to be sort of on the ground, helping kind of fight that battle and make this a more robust asset class. And then the third thing is, this cannot be a bad thing. It's just another option. And so there's different sources of equity. There's venture debt, which usually is paired with some sort of equity, and then there's this solution. We spend 0% of our time trying to convince anybody that our solution is better than any one of those other solutions. Put it in your model, figure out what dilution costs you, figure out what about a 20% per year cost, all-in cost of our solution is. Whichever one's better and whichever one's available, go and get that one. We don't need to convince you. We put out the solution that we provide, and those that it works for will work with them, and those that don't want to explore that, that's fine too.
Yeah. Good. Any final words, Alex?
I think that we serve a very similar purpose in the I think point 2 that you made, which is that I'm not going to give a valuation that's not going to be credible if the level of commercialization, the amount of IP, the relationship between the IP and the product and the commercialization isn't ready to waste our time going to debt or equity providers. And so that's one of the things that we work with strategically with a company to do.
Great. All right, we're going to go ahead and take some questions from the audience now. Maybe we'll start from the live stream so that those folks don't feel left out. Can I just have that, please? Thank you. Good. And then, do we have a mic that we can pass around for folks in the audience to ask questions? I'll let you figure that out while I do this. All right. Okay. Are there I'll let any of you take this. I think it's a good question. It's worthwhile asking. Is it worthwhile to get a portfolio that is only made up of 3 or 4 patents getting valued? Or is it more valuable to get a valuation later on when the portfolio is larger, like at the 20-plus mark that we talked about before? I'd imagine there's some scenarios where it makes sense and where it doesn't. But do you guys want to take a bite on that one at all?
I would say, if this is coming from the borrower perspective, I would probably not do my own, like hire a third party to value my own IP. I would have a capital source that you're working with, work together with the borrower to decide who to hire.
Yep.
We've seen so many IP valuations at numbers that are just it's just meaningless. So you might not be getting any value out of it, and it's going to take time and it's going to take money. So I would maybe hold off until you've had some conversations with capital providers that can point you in the right direction of the types of valuations that they'll actually take into account and consider.
Yeah.
Otherwise, you could be wasting your time.
Yeah, time and money, most likely. Yeah. And then there's a few other questions here. Some of these things we've already talked about. There's one about different valuation processes and different models used for that. But I'm actually thinking that it might be more useful to talk about a little bit more about when to get these valuations and the utility of that. I think that my personal experience is also that making sure that you get a third party, you want the data to have as much integrity as possible. So that's an easy answer, to get someone that is a third party to do it, right? Where we're commonly asked for folks to us, well, hey, can you value our patent portfolio or something like that? And in some rare instances, we'll do a little bit of that work, but it's definitely not our specialty at our firm. And we have firms like Miller Hill IP and some others that we work with regularly that we believe have like data integrity. And as folks have mentioned, I mean, literally, when you talk about it's an understatement to say that they're kind of all over the map. I mean, we want to like double click on and emphasize that like you can go to an evaluation firm sometimes and they'll be like, you might make like some like magic, like gas station energy pill or something like that, and they're like $24 billion. And they're like, well, that's the entire gas station. Like, this is the total amount of sales they do at gas station products a year. And this is if you got full market penetration of every product that they sold. So it doesn't make any, it's like a number that doesn't make any sense, and that someone wasn't properly educated on to be able to present it to a prospective investor in the first place, which is kind of to the point that you're getting at. If you can speak with the folks that can get you aligned properly and in the right, pointed in the right direction, then you'll know when you're looking at something that has some data integrity or that does not, right? Like anything else that we do in business, but especially in nascent areas that we're just beginning to learn more and more about, you have to work with people that you trust. Like it makes business and life so much more fun and enjoyable to do so, but it's also going to make your path to being able to get capital and to accelerate your business that much easier. Because if you start hitting little bumps and you need to make changes along the way, which inevitably does happen, but if you need to do that, there's always someone else that didn't need to do those things because they were working with trusted folks from the get-go and not making all those missteps. So,
I was just gonna, if I could add, Keegan, I think that my answer to the three or four is like anything. It depends. It depends. We will work with a firm like Caldwell and others to understand deeply the scope and the strength of, and to your point, what kind of market this is. Is it nascent? Is it established? All of those things matter. In my experience, more so than just the number. I don't think that there's a magic number. So I know that's a bad answer, but it depends. But go to your IP law firm or a valuation provider like ours, or seek out information to say here's the 20 different dynamics that are happening right now in the stage that we're at.
There's a lot of learning still taking place, even amongst all of us here that are knee deep in doing this all the time. And so it is important to reach out. And as Mark was pointing out, I think that part of all of our, especially of our own responsibility too, is to make sure that we're educating folks properly. It's to the benefit of us and to Mark to do so, because we want folks to come to us and to trust us when they are ready, and to know when they reach that point, and that we gave them valuable information so that they knew when they could turn that corner.
Can I just add to?
Go ahead. Yep.
One of the questions was when you should do it. Well, I think that's an important aspect, because I don't think there's a point of doing it for yourself necessarily, but maybe it's to motivate you that you've done something of value. But I think when there's a fundraising exercise or a requirement from the funding side, you should do it. Or if you're looking to exit, what I find quite interesting to do is look at patent landscapes to understand what your competitors are doing. And I've done this quite recently with Keegan, and we hadn't done it before. And just to see who's doing what in the industry is a good indication where you might want to put your chips down. And also on the back of that, a valuation exercise, because you want to compare your valuation with their valuation. But it's always going to be individual to the company's position and why they're doing it. No one wants to spend money needlessly, but sometimes you've got to invest in these things. So you've got confidence when you go and talk to, say, an investor, that it's not me telling you, it's these people there that you might trust better than, of course I'm going to say it's valuable. It's my job, isn't it? But you want to get someone else to say that it's a good, valuable IP, because it's about trust and so on and so forth in business, and someone else needs to say it.
Sure. Do we have any questions in the audience here? Does anyone have any questions that they want to ask? Please go ahead. Mona's going to come give you a microphone so that the folks in the live stream aren't.
So I have a question relating to IP infringement. I think particularly in the digital age, it's easier for someone to take someone's IP and pass it off as their own, and so someone else. Or do you believe that the US or US IP protection laws are sufficient to hedge that risk?
Um, I'll answer some of that question because it's something that we deal with regularly. So I think that this largely has to do with, is this mic hot still? Feels like it's not.
You want me to lean in, Keegan?
Can somebody on the live stream, can you guys chat? On a lag. So the question, it really largely depends on where exactly you're deploying the assets is my personal perspective on this, right? So do I think that patent infringement is going to play a large role in how these investments are made? What I've observed personally is that folks making the investments tend to be a little bit risk averse to not wanting to make investments where they're actively litigating. That's my personal perspective because it's a distraction from doing what we need to do, right? And but to that end, where you're going to have the most value for your patents is going to be in jurisdictions where you have the ability to do just that, to be able to collect damages from folks that are infringing your IP. And that doesn't apply everywhere, right? So like in the United States, for instance, we have a complex damages system that supports that. In Europe, we have a complex damages system that more or less mirrors what we have in the United States. But in Canada, there's just an injunctive system. So, for instance, in Canada, if we had a bunch of patents in Canada, someone's infringing one of our patents and technologies in Canada, we can take them to court and be able to stop them from continuing to take that technology, which may take lots of time, hundreds of thousands of dollars at the low point, maybe millions of dollars. But then, at best, it's just going to be stopping them from doing that in the future. And by this time, maybe they've already taken so much of the market share and made some other competing products, or maybe they shut down the entity altogether, just open a new one. Instead of Jeremy Company number 1, now they call it Jeremy Company number 2, and they start making a similar product all over again. So, anyways, I do think it's a factor, and I'll let you guys go ahead and jump in. But I think the key point is we want there to be a large asset value, and one thing we haven't talked about also is I have seen where, like Aon, for instance, is adverse from investing in maybe a particular drug technology, and the reason why they're not generally wanting to look at pharmaceuticals is because the patent strategy typically is file 1 or 2 in the United States, proliferate those patent filings across the jurisdictions all over the world, right? But now if you invalidate one of those patent filings here in the United States or wherever, the international filing itself, then the rest of those other 20 filings that you had that are attached to that one have the potential to also fall or be invalidated, right? So from an investor perspective, then you end up not really dissolving that liability as much as you do if you have 20 families of patents that are all separate, right? So that's why that's kind of a key point and something that is different from the way that I was taught to develop patent portfolios when I first got into intellectual property, which was that you would really build out families and have a lot of connected patents, and because you always wanted that earliest priority date, right? So now the strategy, though, is still to file everything as early as you can, but to file those things separately, because you're still going to proliferate those families. You're still going to have all those early filing dates, but you need to be able to have the separated families in order to dissolve the liability, not just for the investor, but also for any sort of valuation that's going to have integrity, because the same thing applies. If you were to knock one of those out, then and you have 20 different families, you've still got the value of the other 19 families. But if you got 20 patents and they're all part of the same family and you knock one of those out, you've just dissolved the whole value of the portfolio, and now you're left with nothing and a debt that you can't repay. And people that might not want to invest in your next company. Does that answer your question? Okay, good. Sound is coming in and out, they say, on the live stream. It should be good now. Okay, you figured it out. Okay. We got a question. Okay, yep.
You guys acknowledged that this is the early days of this world for both the investors and the entrepreneurs and everyone involved. I don't know if you guys feel like making predictions about the conversation that we might be having about this a year from now or a few years from now. At what point does this become more mainstream? What kind of other factors the economy might think?
Yeah, it says it's going in and out. So that's okay.
What I worry is in the mid-term, especially we'll talk about AI at the moment, you don't have to be an expert to create expert opinion. So I think there can be a flurry of patents being created by folks that could just create a bit of an explosion in this area. I think how many patents get filed every year versus 10 years ago? Are we seeing an uptick?
A large uptick. A large uptick.
And I think that's going to continue because it's going to be probably easier for people to write stuff that otherwise was very narrow expertise to write. That's my personal opinion.
Yeah, I would say, I think two things. One, at least the solutions that we've been working on are a little bit too expensive, and they take a little bit too long. So that's something that when we talk about those four parties, the borrowers, the lenders, the insurance companies, and the valuation team, everyone's acknowledged that we need to do better there. So I think that's happening. I think we have a really unique time in the evolution of this product right now, given there has been a pullback in venture equity. There's been almost a full pause on venture debt. In the short term, I think we've got, I won't predict how long, but we've got a window here where this solution is maybe one of the few places where you can get capital. It's open for business, and a lot of deal flow is getting executed. So we have an opportunity to both address those issues and also stand out as a capital solution and a capital provider at a time when the market doesn't have a lot of capital. And so it's our job to take advantage of that. Hopefully we do.
Yeah, and I think that it'll just become, as Mark says too, there's less competitive forces right now for kind of launching this new path towards getting capital with an underutilized asset, because there's less folks dumping money into these other traditional ways at this particular moment. I do think that as we go on, and as we've already seen the last few years, that even with this particular solution, it is more and more folks begin to become hip to it, that it's going to become more and more competitive. We've already seen this, like with Aon, where in the early days of that, it was quite a bit, I would say, you could get more serious looks, maybe easier was my experience. And then where today that there's, like there used to not be a 20 patent minimum. That was something that was established over time, right? So that they might have looked at you if you only had 5 patents, 2 years ago. But now today, the likelihood that they're gonna, they might take, they don't, I think that their policy is to not say no to anything right off the bat, but the likelihood that you'd get a serious look with something like that is pretty much zero. So I would expect this to continue to get more and more competitive, but I think that that'll have some advantages as well, as we'll begin to see other insurance companies get involved with this. We'll begin to see other funds provide solutions where maybe you don't need to have 20, that you can take a smaller patent portfolio of 10, say, right? And that you can be able to get smaller debt solutions. and then I think that there'll be more tools that'll be offered for folks that want to use this, and then they'll just folks will have to figure out which solution works best for our company at this particular time, right? And I think the thing that this has going for it always is non-dilutive, and that's what it always settles at, because whenever you're going to give up equity, and there's certainly a place for it, even at what folks might consider a high interest rate for debt, giving away equity, the cost of capital is so massive. It's easy to be competitive on the debt side, and it's easy for it to make sense, even when there are those competing forces. So I think it's something that's here to stay, and it's just going to be more and more unique tools that are offered as we continue to move forward. I'm looking at questions here. Was there another question in the audience over here? We had a couple here. Yeah, go ahead. I'll repeat the question. I can repeat it. I think maybe the switching of the mics is what's getting, because it's like the people on my live stream here are like, the audio went out, the audio's back. Okay, I'm just gonna keep it going.
You're all industry agnostic. You're all like different industries. So I was gonna ask, like, how important, because obviously when you're a startup, you don't have the money to get hired unless you're in an accelerator. You don't have the money to, unless you're in a law firm. You have law firms sponsoring you to get a patent actually processed. So how important is it for you four that are on the panel to have a patent? Because we're discussing patents and you kind of touched on it, and especially in the real estate. But how important is it for all four of you if you don't have a patent because you're a startup and you don't have the money to actually have a patent for you guys to actually raise capital and give you money?
So the question, just for folks on the live stream, is how important is IP going to be for doing a capital raise, whether it's equity or debt, and how do the panelists deal with some of that?
I think, from my perspective and from a family office experience, not to have a cop-out of an answer, but I would really say it's more of a case-by-case basis. It really depends on the industry that the company is in, as well as the financial metrics and the growth trajectory for that company. In the early stage, I think there are often fewer metrics to define the success of a company. By the time a company grows to a venture growth stage, there are often significant revenue, pathway to EBITDA positivity, if not already there, a robust cap table, to Mark's point earlier as well, and other indicators that you can really see the success and exit strategy for those companies. I think it's less important from that perspective, but it also depends on how the company is engaging with the market in general. So if there is, if the company is trying to engage in a SaaS model, I would say that it's vital that there's a patent strategy and a large focus on the IP portfolio to protect the intellectual property as well as the trade secrets for that company. Our family office has engaged also in non-IP focused investments in the logistics space, in the staffing space, and I think it's less necessary from that perspective, but there comes a point with the growth of a company that if there is an exit on the horizon, you are going to have to differentiate yourself and protect your trade secrets to ensure that you are not overtaken by competition or that you're not knocked off, for lack of a better phrase. So I do think it's a case-by-case basis, but I do think that the trajectory is that it's more and more important as we continue to dive deeper into the tech sector. And you see with the advent of AI as well, I think that protecting what makes you unique is an integral strategy for any company.
Yeah. Just I'd add to what Oliver said. It is case by case. In one of my companies, we spun the IP out of Princeton University. So the first check from the first seed institutional investor for $250,000 was because of the IP. Absolutely. Though I was looking at the business case, I just was not so concerned about the IP because it's almost like fait accompli. You've got to have it to protect the position. It wasn't high on my agenda, as I said. It was a business case. On the other company, the IP came later. The patents came later. So, case by case, depends.
That was a great question. Yeah. Do we have any more questions in the audience? Go ahead. So the question is, are the investors contemplating what they might do with the IP in the event of a default on the loan?
Yeah, so for us, almost always the best outcome is you sell the IP along with the company as a going concern. And we haven't talked much about covenants and some of the concerns that borrowers have around debt solutions. But one of the ways that we get our borrowers comfortable is we are not the best owners of IP. We don't want to own it, and we certainly don't want to be liquidating it. What we want to be doing is, if things aren't going to plan, if the borrower is not able to monetize the IP as they thought, well, then maybe we need a new team in there, or maybe we need to bring it to a third party that can commercialize this better, or we need to rethink the go-to-market strategy, or we're emphasizing the wrong channels. We need new distribution partners. We're going to go through all of those scenarios first and try and figure out a way to make this a going concern, to have somebody buy it before we talk about liquidation. But to the extent, we're obviously always thinking about that case where those things don't work. For us, one of the major focuses is how is a existing competitor going to think about the make versus buy decision? So we'll run into feedback of on certain deals from folks that say, well, Microsoft could do this in 2 years. If that's your bar, then you're probably not going to do any deals. Microsoft can do just about anything in 2 years, but are they going to? So take an extreme example or a more obvious example. If you've got an FDA cleared medical device, Johnson & Johnson can go and figure out a way, even if you've got patents, to probably get that device to perform similarly using some other technology. But then they've got to develop that technology. They have to make sure that they're not violating your patents. Then they have to go through the FDA clearance process when they could just buy this, right? It's already FDA cleared. It's already got the IP. It's got the technology. Johnson & Johnson's probably better at commercializing that than the standalone company. Are they really going to spend the time and go through the brain damage of making, or are they just going to buy? And that's a major component of our diligence and a major component of the upfront triage as we think about what borrowers we want to work with.
Yeah, great question. The other thing that got brought up too was contemplating exit and what's going to happen there. But there's a lot of data that's recently released also that companies are exiting at a 5 times higher rate that have patents. And then I think for the investors also that an important consideration for all parties, that an important consideration is that like the average exit value as published by PitchBook for companies that have patents is 148% higher than those that are exiting without on a PE exit. And then the stock price that folks are getting is, I think, roughly 40% higher for companies that have patents than those that don't, also that are IPOing. So it's hard to, as Oliver was saying, like even for industries where maybe on the front end it doesn't make a whole lot of financial sense to have IP, at some point, in order to distinguish yourself as being a technology company versus maybe just being a logistics company, like the number one thing that's going to be able to distinguish you from being one or the other is by having patents and then being able to connect those back to the offerings that it is that you have. Go ahead. Yep.
Hey, my name's Will Taylor. Thanks for all the panelists for sharing your expertise. I'm in the music space, and I was particularly curious to know, your outlook on music as an alternative asset, and if you were offering IP-backed debt lending, against like the master copyrights for artists that have like a pretty substantial catalog of royalty earnings.
I can speak to that a little bit. I know. I mean, these.
Repeat the question.
Oh yeah. So the question is, can we utilize the copyright asset value of music in order to do debt against? I'll let you guys answer, and then I actually have kind of a follow-up thing. And I think that I think that probably today it's too early to do things like that, but there's some way to do that maybe down the road. But there also might be some creative person out there that does things like this today that I don't know about, which is more likely the case also. But you guys do you want to take a stab at that, Mark?
Yeah, I mean, there's an entire lending industry, I should say investing industry, around royalties, both pharma and music, and even getting into YouTubers and really any sort of content. And it goes back to like monetizing that content. That's what you're doing with music royalties. Music royalties and royalties in general have this long-term cash flow stream aspect to them, which are very attractive to lenders. And so, I mean, we've seen there's 3 or 4 big investment firms, brand name investment firms that have started royalty-focused businesses. And again, it's a little bit of a hybrid of debt and equity. I would say it's established, exists, going to continue growing. It's institutionalized, so you've got U.S. pension funds that are investing in these royalty strategies, which is certainly a sign that it's going to continue. But it is separate from the exercise that we're doing on IP. Oftentimes because you're actually generating cash flow from royalties, and so it's much more of a quantitative exercise in valuing those cash flows versus all of the art that Alex puts into next to his quantitative analysis around IP. So I actually think it's an easier asset class that's tangential but not directly related to IP lending.
Great question. I just learned something new. Please. Mm-hmm. Okay, great. So 2 separate questions there. I'm just repeating it for the folks on the live stream. One, so this audience member has like a modular home manufacturing business, tiny home manufacturing, and is curious about experience with IP in that space, and then also asking the lenders directly if they're more inclined to lend a particular company money, whether they have IP or not.
Yep. Take a crack at the second question, and I know you have an answer as well, Mark. I would say in terms of the metrics for a candidate to as a borrower, I would say that if you're lending against the IP, then it's important that the IP has a pathway to return and pay off that debt. So often, going back to earlier in our panel, talking about equity versus IP-backed lending, equity dollars can fund R&D, litigation, growth, et cetera. But if you're really doing IP-backed lending, there has to be a pathway to pay back that debt with the capital that you're onboarding. So from that perspective, I think a company that has robust IP would be a great candidate for equity, but I don't think it would change the ability from a debt perspective unless you're directly lending against that IP with a pathway to paying off that debt. So I think it would really it would be circumstantial in that regard. But from my perspective, I would say that if you're going in for a specific IP-backed lending, then it would really be serviced by the IP itself. But I'll turn over to Mark. I know you had more commentary.
Yeah, I mean, we're not that interested in lending against a standalone IP portfolio that's kind of static and just sitting there. That's not, there may be folks that do that, but that's not how we think about it. We want to be funding businesses that are IP enabled and commercializing those. And so we want to evaluate that commercialization. We believe that that piece of the diligence is what we've done for years and years, and we can kind of get our arms around that. And then we want to add into that the quantitative and the qualitative aspect around valuing IP. So much prefer having an operating business there along with the IP. Mm-hmm. And then I would say, just in general, you mentioned manufacturing. I probably didn't do a great job of giving examples around like what's a really attractive deal. A real attractive deal is good, robust IP portfolio, been selling the product for a couple years through one manufacturing facility, and now you need capital to build manufacturing facility number 2. That's like perfect profile for an IP loan. That's exactly what we want the capital to be used for, and the profile of a company that we want to see in terms of a borrower.
Yeah, and I think I would just add that in the case where folks are just looking for money to get a portfolio that's kind of separate from a company, most of the time when that's happening, it's usually some litigation funding. So someone's taken that portfolio and they want to directly go monetize that and to send cease and desist letters out to people and to try to make money by enforcing that IP. And usually in that scenario, where folks are getting debt, they'll go get it from a litigation funder, which is different from this, and but quite possibly where this is spun out of is the competitiveness in the litigation funding field, and realizing that there's enough asset value to lend against there, to why not be able to do it in this other creative way.
It's already started.
Yeah. So I don't think there's any more questions in the audience. I think one more. Go ahead, Scott.
I have a question concerning a remark that Mark and you made.
Okay.
Mark describing 20 patent families.
Yes.
And you talking about 10 or 20 patents, both in the context of either a startup or an established company using the IP to further business, further commerce,
Mm-hmm.
not as a standalone asset. The patent family, to me, is curious. A company that, to me, has 20 patent families is a huge company. I would think you have to have 20 different foci in 20 different disciplines, all funded with people and money, to have 20 different families that have each family has a business associated with it, as opposed to what you said, a company with 10 or 20 patents.
Yeah.
That to me would be one family. Assuming the patents were specifically granted against one technology.
Yeah, so kind of going back to what I was saying earlier, so the question is basically, I'm not exactly sure what your question is, but it has to do with
Families
Well,
versus-
are we talking about 20 patents?
are we talking about 20 patents or
patents or
20
20
patent
families?
families? And we're definitely talking about 20 patent families, but the caveat there is that if you make 20 separate patent filings that are not attached to one another, they are 20 patent families, right? So when we think about patent families, you're thinking about this has got all these things attached to it, right? It will eventually, but it's just that they're separate. That's it. 20 separate patent filings. That's what we're really talking about. So without getting too carried away with the family thing, because those families will get built out over time. You're going to want to keep those open in order to monetize them, right?
I think it's
In
also
general,
important that
yeah.
it's the ability that the invalidation of one won't domino into the others directly.
Yeah, exactly. Yeah, and to not be able to do that. But you bring up another great point, Scott, and that's that. Does that seem like a lot for one company to have? And I think that it varies greatly. So like we talked about tonight, there's some companies that like very early stage, like we represent companies that have over 500 patents. That we actually represent a handful of companies that have over 500 patents, some over 1,000 that don't even sell a product yet. And so you can go from companies that are still like in stealth mode to companies that, and there's very much a reason for them to have that much. It's like a necessity of their industry. But, and then there's, I would say more commonly though, you have folks that they've gotten some funding and they've done the R&D and now they're getting to this point where they're beginning to commercialize some product, and somewhere along the way that, they've kind of gotten some sprinklings of IP along the way. And now it's just about, folks generally when they end up coming to us, they're shoring that up. And then part of that shore up is sometimes either because they went to the funders and they said, you need to go get the rest of this done because it's not quite done yet, or you're coming to us and we're saying, this is what the funders are saying, that we need to have, this, it needs to have this sort of character in order to do it. But I think it's just the separate filings, not necessarily through these large, highly populated families. Yeah. Okay, good. All right, well, thank you everybody for, we got one more question.
Well, just right on that specific topic. So I'm an inventor and I have several patents that I'm filing, but I'm always interested in different kinds of IP strategy.
Yep.
I was speaking to a firm that are called Strong Force Analysts.
Mm-hmm.
They have a really interesting IP approach where they were discussing filing very large patents, 500,000 page patents. Of course, obviously, it all has to be enabled.
Yes.
But their strategy has been to file those large patents in emerging fields and then to file continuations of patents off of them.
Yep.
Kind of essentially creating the ability to stamp mark you got the priority dates, but also
Yes.
kind of lay hold those in the future. But is that kind of counter to, I mean, in some ways to your families where you've got these protections? I was just curious about what your thought was on that kind of strategy.
No,
as far as IP.
Sure, it's a great question. So the question is it the strategy of filing like a large omnibus kitchen sink patent, including all the information that the whole company does in that one thing, filing that, and then making continuations, children off of that patent for years and years and years and years so that we can take advantage of that single priority date, right? Versus doing a bunch of separate filings for all of those. For this particular thing that we're talking about today, and I would say just in general, this is my own personal perspective, certainly not legal advice. Of course, I have to say that. But that if you, listen, like I think that there's a place for these large applications, and we even do them at our firm, but it's usually when someone comes to us and they don't have the capital to do all the separate filings. And so we say, listen, well, let's just do something that's prophylactic based on the budget that you have today, which is make one of these large filings, and then we'll figure out the rest of it down the road. But that is generally not to just do a bunch of continuation practice off of that first one, though. Because if you invalidate the one, then a lot of those other ones are going to fall. And it diminishes the value for potential investors, right? So that's what I'm saying is that the priority date is not the only thing that rules here. There's other liabilities that are out there. And the other thing that didn't come up today that is, maybe an important point is that the asset value of these patents, or something, actually, you just brought this up also, and Mark did too, that one of the things that they want to do is be able to connect the patent to the product that it is that you have. But just because you have a portfolio of 20 or 50 patents or something like that, every one of those isn't going to be connected to an exact product that you sell today either. It could be something that's on the roadmap for down the road or something like that too. So it's not always going to be the case that that's true, that each patent is connected to a product that it is that you've already commercialized or something like that. It could just be something that's on the roadmap. It could be something that we thought we were going to commercialize, and then we gave up because, you know, a large investment in IP usually comes with some predictive measure of patenting also, because if we can predict where the market is going to go, those are going to be some of the highest value assets, right? So I do think there's a place for doing large omnibus patents, but I think that ultimately when companies have the budget for it, that they should consider filing separate families and then over time building out those families rather than relying on the strength of one priority date, because it's the level of sophistication that investors have and that other companies have at this point, because other companies aren't going to view that as being very intimidating either. Like when we go to enforce a patent against some other company and we're looking for companies to enforce against, we're looking for, number one, companies that we can enforce against, but then who doesn't have patents or who has a weak patent portfolio. And those would be candidates that we would seek for that. Yeah. Cool. All right. Thanks, everybody. We appreciate you coming out today. Please, go ahead and feel free to grab someone as you have a drink in the back here. Live stream folks will make sure that we make this stream available to you. We'll send it out, link out by email. I'm not exactly sure when that'll be, but that'll happen in the not too distant future. And again, we just want to say thanks for making us feel like a welcome part of the LA community. We're glad to be here. And thanks to all my panelists for coming out and sharing all your knowledge base with the community here today. Thanks, guys.
Pleasure.
Of course. Yeah.
We gotta chat.
TBD. There you go. Oh, gosh, I gotta go to the bathroom.